The man you're looking at there on your screen, his name is Stanley Druckenmiller. He's one of the most legendary investors in the world, net worth over $6 billion. He has absolutely loaded the boat on IWM call options, okay? He has also sold out of the majority of his NVIDIA shares. So in this video, I want to talk about both of those moves and kind of give my opinions and perspectives on loading the boat on small cap call options, as well as selling out of the majority of NVIDIA stock. I'm going to start out here with a big dog. Okay, legendary investor Stanley Druckenmiller filed, obviously, his first quarter 13F, right? Sold over 70% of NVIDIA and then loaded the boat on small cap call options. What in the world is going on here? Okay, so first off, let's start with NVIDIA, then we'll get into my opinion on the small cap play there, okay? So in regards to NVIDIA, he likely sold the share somewhere between $470 and $950. How do I know that? Well, look at where the NVIDIA stock price was in the first quarter. NVIDIA stock price was anywhere between $470 and $950. Today, the stock is about $943. So ultimately, whatever he sold shares at, it's likely significantly lower than where he could have sold at if he just held to today, right? So that's the first thing we got to kind of factor in there. Now, obviously, I'm sure he is, never planned to sell the top in regards to the situation, but clearly it's a sign that he thinks either the company's long-term topped or short-term topped. I'm guessing it's not a long-term topped situation, because if he really felt the company was in jeopardy or in danger long-term, he would have also probably opened some sort of put position on the company, and he also would have sold all his shares. He wouldn't have sold 71%, he would have sold 100%, right? It doesn't make, if you think the company's got long-term damage ahead, then you're not going to stay in any shares, right? So my guess is he probably thinks the company, or he assumed the company in the first quarter was going to top. So I don't know, he might have been selling shares at 500, 600, 700, 800, right? Maybe 900. And my guess is he probably thought the company was going to short-term top. Obviously, it has not, right? Now, with that being said, he's not the only one taking profits out of NVIDIA. David Tepper also took profits out of NVIDIA as well. Now, in regards to David Tepper, arguably the worst owner of any NFL football team, what he has done to the Carolina Panthers, damaged his reputation in my eyes. But anyways, as somebody who lived in Charlotte for a few years, NVIDIA, he brought his position sizing down, but it's not like he did a dramatic cut in terms of like a Stanley Druckenmiller type cut in terms of like a 70% cut. Much smaller for David Tepper overall, right? Now, I mean, there's a lot here to kind of factor in regards to this. First is, I listened to Stanley Druckenmiller, I think it was last week. We reacted to him on the Reaction channel, if I recall. And the first thing was, it sounded like he didn't really understand the company. And there's no shame in that. The man's 70 years old, and he told the story himself. He told the story about he was brought the stock by somebody on his team, and they talked to him about it, and this was, a year and a half ago, 2 years ago or so, and he liked what he heard, and so bought the stock. And so when you make a ton of money from a stock, and it wasn't even necessarily your stock to begin with, and maybe you don't even fully understand the company or what's going on there, you got to take that profit. Like it just makes sense, right? And so I think that's the first thing we kind of got to factor in here. Next up, I mean, you made a lot of money. A lot of people, they like to take profits, right? It's just natural. You want to book some gains, especially with all the uncertainty we have out there in general. Sometimes it just feels good. Like, oh, I booked the profit. It feels, it's like a weight off your shoulders to know, you took the money. You took the money, right? Now, is this the right decision? Well, if we look at NVIDIA, right, 1000xstocks.com, which we are now at about 500 people on the wait list. If you haven't joined the wait list for 1000x, I would likely go ahead and do that. You can go to 1000xstocks.com. I was listening to conference calls right through 1000x last night. You can compare stocks versus each other, figure out if stocks are undervalued, overvalued. It's an unbelievable service we're building out there, right? NVIDIA trades at quite a bit cheaper forward P than ARM and AMD, right? But the fascinating thing is here, as far as next year's revenue growth expected, all these stocks are around the same. But in terms of this year, NVIDIA has the most revenue growth expected, right? And so when I look at NVIDIA, I think it's the most discounted. If you're going to compare them versus peers of ARM or AMD or other companies like that, they are the deal. Now, secondly, you should also pay a premium for AMD or for NVIDIA, right? And the reason being is NVIDIA is the company at the center of the universe. ARM is not. AMD is not. They're good companies. They're doing their thing, right? Good for them. But they're not the center of the universe. You're the center of the universe when every other big tech company in the world is bowing down to you and putting you in the presentations and putting you in conference calls and talking about, we're going to have your chips pretty soon here and we want as many chips as they can send us. That's the center of the universe. So NVIDIA is the center of the universe, right? And on top of that, their numbers are likely going to be the best out of any of their peers, and they're trading at a cheaper forward P. So if anything, NVIDIA looks absolutely phenomenal from a long-term basis and a short-term basis, right? Now, if they had a weaker guide than expected, maybe the stock drops down to 600, 700, something like that, right, over the next month or two, if their guidance was weak or something like that. But you got to understand there's a lot of people that are very, they need to own more of NVIDIA stock, or they don't own any NVIDIA stock. And so I think it's actually a bullish sign to see some of these folks taking profits, because these folks might end up buying shares back, and they might be buying them at much higher prices in the future, right? Little food for thought in regards to that. I remember in ELF stock, right? I remember taking gains on ELF stock of 100%, 200%, and thinking I did well for myself. And did I screw up? ELF is a 2,000+% gainer for me. So, you sometimes you think you're being smart, taking a profit in a great company, but for truly great companies, usually every profit you take, you end up regretting it long term. In value stocks, dividend stocks, it's a little different. Sometimes you take profits there, and those stocks can become dead money for several years, right? If you're in a company that's a bad company, right, and you happen to make money in it, taking a profit makes sense. But in truly great companies with great CEOs, great business models, great long-term futures, usually every single profit you take, you're going to regret it. And ask anybody that's taken profits in NVIDIA for the last 5-10 years. You know how many people have taken profits in NVIDIA stock the last 5-10 years? And how many of those people wish they held those NVIDIA shares? 100% of them. Think about that for a moment. All the people that made money in NVIDIA stock the past 10-15 years, and every single person would have been far better off if they just held, right? Let that sink in for a moment. The solar system. Next up here, let's talk about small caps, right? He's playing heavy calls on IWM, on Russell 2000, right? So, first up, 3-year chart of the Russell Wilson is rough, right? It's down 7% or so in the past 3 years. So, clearly there's, and this is meanwhile, if you look at a 3-year chart at S&P 500, NASDAQ, Dow, it looks pretty dang good. So the Russell has a lot of catch-up to be made here. Now, to predict exactly when that's going to be is difficult. I mean, extraordinarily difficult to know exactly when, because if you're playing call options, you're under a time constraint, right? And so he's under a time constraint here. He really needs, small caps to really get moving over the coming months here for obviously his call option play to work out phenomenally. Now, the second thing, and what's more important in this situation, is this, okay? Fed funds rate. I think this play by Stanley is him basically believing that the Fed's not going higher in rates. He wouldn't be buying these calls if he felt the Fed was going higher. This is basically Stanley saying the Fed's going lower, and they're going lower probably pretty soon. That's the only reason you would make a move like that. You have to be confident the Fed's going to make a move. Now, keep in mind, these moves were made in the first quarter. Now, in the first quarter, we hadn't had the newest 2 CPIs out. We didn't have that 3.5% and the 3.4%. So it could be possible that Stanley is already looking at this and saying, damn, I shouldn't have done this. That is a potential, right? Because now CPI is even higher. Now it looks like Fed rate cuts are being pushed off to maybe September or maybe to 2025, right? Even, if you're thinking something was going to happen in June or July, I don't think it's looking super realistic. Because in my opinion, the Fed has to see 3 consecutive months in the 2s. Well, we don't have enough time to see 3 consecutive months in the 2s. So at the earliest, you could maybe see a fall time cut, or maybe it's in 2025. So he could be potentially, regretting the move. I don't know. We'll see. But if he's right about the Fed cutting, then that could potentially be bullish for small caps if the economy doesn't get devastated in that amount of time, right? No, I reacted to Tom Lee in today's reaction channel video. I'm not sure how many of you guys follow me on that channel as well. I'm sure a pretty good chunk of you guys, where I would just react to a bunch of different videos and things like that, right? And I reacted to Tom Lee. And if you don't know, Tom Lee's had this call about small cap stocks going up 50% this year, right? And they asked him about it on that, Scott Wapner, right? Or Wapner. He asked him about it. And Tom Lee, surprisingly enough, doubled down on his call of expecting small caps to absolutely go beast mode into boom for the remainder of this year. So as somebody that owns several small cap stocks, I hope they're correct on this, because I'm going to make a whole lot of money over this next 6 to 12 months if that is the situation. But, it goes to show that there's some real interest from big name folks in the market in small cap stocks, right? And so, little food for thought. Like I said, Stanley might be already regretting it, but as of right now, he's got a lot of call options out there. Right off the bat here, Stanley Druckenmiller is one of the best hedge fund managers of all time. He's got a net worth of $6 billion plus. That means when he buys something, people listen. And in the latest, 13F here, essentially, it is found that he ended up buying about 769,000 shares of Palantir stock. And this is after he sold out of his entire position of 700,000 shares in Q2 2023, right? Now, if we want to look, it's very interesting, because essentially, if you look back to that particular time frame when he was selling out last year, basically Palantir stock was between about $18 and about $16 during that particular time frame, okay? So he's now, recently, if he bought it last quarter, which it was, right, he basically paid 20-something dollars likely for the shares, right? Versus when he sold, it was somewhere between $8 and $16, okay? So there's a few things I would glean from this, essentially. First is, clearly, some things had to fundamentally change with Palantir for the much better that makes him say, I might have sold Palantir shares at 12, 14, 16, 8, whatever, but I'm willing to pay $20 plus for it today, right? The companies had to have gotten much more valuable. If it was a situation where he sold at $15 and then today Palantir stock was $8, you say, okay, he just thinks it's a cheap price right now. It's a good value, right? This is like, to be paying a lot more than what you sold at last year, you've got to feel like the business model, the fundamentals of the company are exponentially better than they were, okay? Second thing, and this is very important for everybody to understand this, okay? When it comes to all these legendary super investors, they make mistakes. They sometimes sell stocks at very bad prices. They sometimes buy stocks they shouldn't buy. Sometimes they sell for losses, okay? You're going to be the best in the world at this, and you're still going to make mistakes. Stanley's made countless mistakes over his career. Warren Buffett has, everybody you ever look up to in the investing world. And you got to have a bit of maturity in this game to understand people make mistakes. That does not mean they lose all credibility or something like that, right? And it happens, right? And Stanley's, he made a mistake selling NVIDIA recently, just to be quite frank. He sold those shares likely between 400 and 900. Today, the stock is, significantly above that, obviously, right? And so, if I look at myself, public count, we have trounced, absolutely destroyed the S&P 500 in the public count over the past 5 years, right? It's not even close. It's not even close between my performance and S&P 500. Guess what? I've also made plenty of mistakes the past 5 years. That's what happens. But as the name of the game is, are you still killing it, right? That's all that matters in the end, right? And so people sometimes put too much faith or too much disrespect when it comes to these legendary investors, where they look at these legendary investors and they think they're perfect and every move they make is the right move and you got to follow them. Absolutely not. They screw up all the time. And at the end of the day, there's other people that look at them and they try to say they don't have any credibility, and it's like, yes, they do. They're still phenomenal at this game. Every athlete loses a game, and I think ultimately it comes down to people that don't really know that much about the market, or people that they never really did anything competitive in life, and they really haven't achieved anything, so they don't understand, you take losses in life. There's no such thing as a perfect record. You can ask any one of these legendary investors, and they'll tell you they have so many mistakes they made over the years, and at the end of the day, they still became billionaires. They still became, more money than they ever know what to do with, right? So just a little food for thought in regards to that situation, okay? Next one up here, Gabriel Santos. Tell us why the hard landing is not coming.
Was Justin Timberlake with Gabriel Santos this morning, chief market strategist for the Americas at JP Morgan Asset Management. What do you think of him? The singer.
JT?
Yeah.
Has a beautiful voice.
Yes, he does.
Beautiful.
Yes, he does.
Good golfer.
And he's a good golfer.
Trolls.
Yeah. So, okay, now we've gone off the rails. Gabriel, we've been talking about, we're going to get these PPI numbers later today.
That's
and I
right.
think, and we're also watching, I don't know if we're calling this a melt up. What are we calling this in terms of what's happening in the market right now?
Well, we had a very brief 5.5% pullback for parts of April, and then almost a full rebound, less than 1% from all-time highs. So ultimately, I think it's just a continuation of the bull market here, the bull case. And I think ultimately, for the bond market, for the FX market, it's still very much all about what's happening with inflation and the exact timing of Fed rate cuts. But I think when it comes to risk assets like equities, like corporate credit, I think we've kind of moved on a little bit. There's more confidence in the base case, which is 2.5% growth, inflation that's normalizing over time, and a Fed in December and then again in May that took rate hikes off the table. And that's an environment where you can have great earnings growth and you can have a continuation of the bull market and very tight corporate credit spreads.
How concerned are you, though? We were talking, I'm trying to think who the guest was that mentioned this. When we think about a presidential cycle, if we don't know who's going to win, there's often a pullback in spending, both in terms of capital spending by businesses because they're not sure what's about to happen, and sometimes even consumer spending. Do you think that's in the offing or no?
I think what's been interesting is in terms of the bond issuance this year, we've had record investment grade, high yield issuance for this part of the year.
Right.
And we've been hearing that perhaps part of that may be taking advantage, that the market is open and doing it far enough in advance of the election. So perhaps that's already impacting certain decisions like that. But if we look at, for example, the Business Roundtable survey of companies, 40% of CEOs say they still plan to increase CapEx over the next 12 months. So I think it's very much an impact at the margin in terms of election decisions.
I wonder how much of...
So in regards to, okay, a few things. First off, if a CFO of a company or if executive team is making decisions based upon who might or might not be the president, they should not be in their role. You need to be running your business to be successful under any environment. Ask any top level great CEO ever, and they'll tell you, boy, you better run that business how under any circumstance. You can't be like sitting around and be like, I don't know if I'm going to buy some NVIDIA chips because I don't know if it's going to be B-Man or T-Man that gets elected. No, that's just ridiculous. You don't do that, okay? Second, consumer making buying and selling decisions, and pulling back whatever because they don't know who's going to be president. Stop it. Okay, just knock it off. If you think, the consumers out there like, you know what, I don't know if I'm going to buy this latte or not because I don't know who's the next president's going to be. I like these Air Force Ones, but I don't know if I'm going to buy those because, I don't know who the next. No. Okay, that's no. No, that's just utterly ridiculous. Utterly ridiculous.
There's just so much liquidity sloshing around. I mean, the idea that you see a 5.5% pullback and all of a sudden everybody rushes in from the sidelines. What happened yesterday with the meme stocks, which is crazy to see that. I mean, this is a market that has plenty of liquidity, and maybe the Fed should pay attention to that too.
And we've talked about so much about the $6 trillion plus of cash in money market funds for a lot of people that were waiting for the hard landing last year, that were waiting for a more meaningful correction to get invested because they were afraid to invest at all-time highs. And I think what you're seeing is really just a capitulation. Look, the hard landing risk is always there, but it's really decreased. Overall, the base case has been underwritten, and investors want to participate in risk assets. So any kind of little pullback, you see investors.
Disagree with her. I actually disagree with her. I believe the hard landing risk has increased. Increased, not decreased. I believe the hard landing risk has increased. And the reason I believe it has increased is because we've been at, higher Fed funds rate for quite some time now. We're going to be here for quite some time to go. It sounds to me like Powell's kind of taken off even a summer rate decrease off the table. So that puts us likely into the fall before we even start to get rate decreases. And keep in mind, as long as things haven't completely fallen apart, they're going to slowly decrease rates. So that means we're going to have been sitting on 2 to 3 years of high Fed funds rate, right? Which is all going to weigh on the economy heavily, right? Which puts you at a much, much bigger risk of things going bad rather than if you just got it done and over with quickly, right? And then when the Fed does actually, like, let's say the economy really starts to go off the rails later this year or in early 2025, and let's say the Fed then starts to cut aggressively, right? At that point in time, well, Fed lags once again. So it's going to take you a year or two to catch up with the Fed kind of easing there. So it's not like it happens overnight. So therefore, I actually feel like the hard landing risk has increased, not decreased, here recently. And with inflation still not defeated, that also makes me feel like, dang, man, you know, this was the moment. Like right now, it should be the moment where we had defeated inflation. It was donezo. We were in the twos already. Fed could be looking to cut this summer. Like basically, if we had already defeated inflation by now, it would almost be a guarantee that Fed would start cutting this summer, keep cutting into the fall, keep cutting into the winter, right? And then I think that was a situation where we could say, okay, you know, maybe we're going to get out of this one without a major recession or something like that. Now, with inflation still problematic, you know, that makes it a lot tougher. So a little food for thought in regards to that.
Buying equities, but also buying corporate credit and buying international equities as well.
I know it's not something you focus on, but what do you think of this whole GameStop situation all of a sudden coming back in the marketplace? Does that say something more broadly about where we are?
I think it says a lot about the psychology and the investing behavior of different generations. And I think it's really interesting to see that, especially for millennials, for Gen Z investors, there's a lot more focus on the short-term investing behavior.
It's kind to call it investing. You know, it's kind to call it investing.
Exactly.
Trading and gambling.
It's trading, it's gambling, it's quick payoffs, instead of, look, we're investing for 5 years, 10 years, which is ultimately the time horizon we should have for equities here. So I think a lot of that is a reflection of a new generation of investors.
No. Baloney. As somebody that runs the private group, right, and I get to hear from folks and I get to see, you know, who watches the channel and those sorts of things, right? You're always going to have a certain amount of gamblers in the market. You've always had a certain amount of gamblers. People just throwing money around at whatever they think the hot thing is, and ultimately these people usually lose money, right? There's still a lot of people focus on exactly what I do, looking at the fundamentals of companies, actually staying focused on building positions in great growing companies that have great long-term opportunities, have real business models with real profits, real revenues. There's plenty of those folks out there. We got 1,000 plus of them in the private group. There's a ton of you guys that aren't in my private group that watch this channel, and you're focused on building your portfolios and on the long-term investing game. So, you know, I just will always push back against that notion of just thinking like, oh, you know, the millennials or the Gen Z or whatever, they're just into gambling. No, there's a lot of those folks that are into gambling. I live in Vegas. It's a city built on gambling, right? But at the end of the day, there's a lot of people focus on the fundamentals of companies, long-term investing. And I think a lot of those folks are the most educated we've ever seen in history, just to be quite frank, in regards to really understanding how the market works, really understanding valuations and financial statements and those sorts of things. Certainly much more so than previous generations, in my personal opinion, because of the access to information. You just didn't have all this before. You didn't have ability to learn from people on social media or just, you know, on the internet and things like that, and get into these very complex subjects. You didn't have the ability to run through courses and all that stuff. And so, you know, and even the softwares, you know, that exist today that are much more advanced than anything previous generations had. So, yeah, there's always going to be a certain amount of people that want to gamble money around.